Emerging markets are gaining attention from investors because they offer higher growth potential and help diversify investment portfolios. These economies, like India, Brazil, and Vietnam, are growing faster than many developed countries due to rapid industrialization and expanding consumer bases. For businesses, this means access to new and growing markets, which can drive sales and profits. Additionally, investing in these regions helps spread risk by reducing dependence on more mature markets. The rising middle class in these countries creates demand for a wide range of goods and services, presenting fresh opportunities. Another important factor is cost efficiency, since labor and production costs tend to be lower, potentially increasing profit margins. While emerging markets bring exciting prospects, it's important to consider the challenges and risks involved, which we will explore further in this presentation. Growing populations and rising disposable incomes in emerging markets are driving increased demand for various products, as seen with Unilever's localized approach in India and Africa. Governments are also focusing on infrastructure by investing heavily in roads, energy, and technology, creating opportunities for global companies. China's Belt and Road Initiative is a prime example that has benefited construction firms worldwide. At the same time, digital transformation is accelerating, with mobile technology and e-commerce opening new business models. Alibaba's acquisition of Lazada enabled it to expand across Southeast Asia, tapping into markets like Indonesia, Thailand, and Vietnam. However, investing in emerging markets comes with risks such as political and regulatory instability, which Venezuela's economic crisis illustrates, causing losses due to hyperinflation, currency troubles, and policy unpredictability. Currency volatility can also impact profits, like what happened with the Turkish lira affecting multinational companies. Furthermore, infrastructure and supply chain challenges, such as poor logistics and unreliable utilities common in African markets, can add costs. Despite these risks, the advantages include high growth potential, opportunities for early market leadership, and access to untapped talent and resources. On the downside, companies face higher operational risks, cultural and language barriers, and vulnerability to global economic shocks. Real-world examples include Coca-Cola's aggressive expansion in Africa and Asia using local partnerships and Netflix's entry into India and Latin America, where it adapted pricing models to fit local conditions. Altogether, these factors highlight both the promising opportunities and significant challenges that come with operating in emerging markets. Emerging markets present a mix of both opportunities and risks that need careful consideration. Success in these regions usually comes from combining strong strategic planning with deep local knowledge, effective risk management, and the ability to adapt quickly to changing conditions. While the growth potential in these markets can be impressive, it's important for investors to evaluate the challenges carefully and keep a long-term view. When approached thoughtfully and with thorough preparation, emerging markets can be an important source of business growth and increased shareholder value.